Why does future inflation expectation hurt growth stocks? Doesn't inflation also mean higher prices and hence higher revenues and higher profit? So it means that higher inflation increases your expectations on return, right? So when inflation's higher, you need more return as an investor to beat inflation. So if inflation's 0, you're just like, I just want a return, right? To beat 0% inflation. If inflation's like 2%, you're like, oh, I need 4% to beat inflation. If you need 5%, it's 10% or 8%, right? So when that grows up, right, your expected and required return as an equity investor goes up. So I did this a long time ago, maybe in December when we first started talking about inflation on my channel, where I did a little DCF comparison of a value stock, free cash flow, straight lined or growing very slowly over 10 years, and one that is 0, 0, 0, 0, 0, 50, 100, 200, like a Tesla or something like that, where when you discount cash flows out into the future, compound interest does this, right? But when when like you think about it going backwards of what this cash flow is worth today, it cuts exponentially the other way. So $100 in 10 years is like nothing, right? $100 tomorrow is something, right? And $100 tomorrow is way more than $100 in 10 years. And that differential changes based on expectations of interest rates into the future, because the higher return, the steeper this compound interest calculation gets. But the lower the interest rate is, the flatter the compound interest rate gets. So that means that cash flows out here don't lose as much value as they would if your expected return was higher. I'm kind of butchering this whole thing and going in circles, but I would just invite you to learn a little bit about the DCF, where I mean, it's a simplistic way to think about it. I think Warren Buffett or Charlie Munger had said at one point that if you were buying a $50 billion company and wanted a 10% return, and that company didn't pay you this year, but would start paying you next year, that company would need to start paying you and they would pay you an annuity into the future. That number would not be 50. It would go to 55 next year if you didn't get it now, or 60 the following year. So yeah, so like really it's like cash today is worth more than cash tomorrow. That's the reason.
So I'm going to pull up something on the screen just to give people an example, a technical example of what you just said, which is brilliant, really good explanation. So from a technical standpoint, this is an example of a very, very simplified, ultra simplified DCF. And just to show you what Justin is talking about, if you look below, you can see the DCF value of this company is $150 billion, 149. If the only thing I change is I raise the discount rate to 12% across the board for the entire 5-year span, it goes to 110 billion. We just lost $40 billion in valuation over a 2% discount increase.
And that's a growth stock, yeah?
Yeah.
Yeah. Versus if it was a value stock, the percentage
no,
loss
for value stock,
value, it does go down, but much less. Yeah.